Hi everyone, this is Michael and Michael again. And as we discussed last time, we're going to talk about the first time home buyers incentive program. And we have Michael here. He is an expert for mortgages and he's been doing it for 7 years. And he's going to share all the details. We're going to talk about if you are, what it takes for you to be eligible, about the date when you need to have a closing, and we're going to talk about the share equity mortgage and what it means for you. So Michael, let's get into it. So what do you need to be eligible for this program?
Well, it was launched on September 2nd, and you can, as long as your deal is closing by November 1st, on or after November 1st, that's an eligible property for this government program.
So just to be clear, so you can make an offer now, but your closing, which is when the I guess the title is transferred under your name and you're paying off the amount of money, that needs to be after the November.
It can be on November 1st or anytime after November 1st.
Perfect. Thank you.
Yeah. Now, the people who are eligible for this are Canadian citizens, permanent residents, non-permanent residents who have work authorization. On this program, one borrower at least in the household has to be a first-time home buyer. Property has to be within Canada, obviously, and in that household has to have the minimum down payment of at least 5% from traditional sources. So savings, checking, TFSAs, RRSPs, or a gift from.
And I believe that was also increased, the amount that you can withdraw from RRSPs was increased by $10,000.
Right, now you can take up to $35,000 out of your RRSP. Now, the other requirement is in the household, you can only have a maximum household income of $120,000 for this program. Now, a little bit later in the podcast, we're going to talk about the possible changes that might happen that Trudeau announced recently. But the basic program that's in place right now, maximum household income is $120,000.
Excellent. So that is what it takes for you to be eligible. Now let's talk about the shared equity mortgage and how that works, because obviously it's great that you can get in and save some money on your payments, because you can take the loan and lower the amount of your mortgage, right? And you don't have to pay any interest on it. But what is the potential upsides and downsides, Michael?
Well, people have to understand, this is the first time we've done a shared equity program in Canada. And what it means, what shared equity means, is if the government's going to put in 5% to help you, maybe get over the threshold or get into a property that you otherwise might not be able to afford, they're gonna share in that, in the upside, and they're also going to share in the downside. So for example, if your home is $400,000 and the government provided you with a $20,000 first-time homebuyers incentive, if the property went up to $500,000, your obligation, should you decide to sell or at the end of 25 years, if the house is appraised at $500,000, you'd have to pay the government back $25,000 instead of the original $20,000. Now, on the other side, if the house price fell to $300,000, and I'm just using, those are pretty big swings, but I'm using them just for simple math. If the house price fell to $300,000, you'd only have to pay the government back $15,000. So, the government has, I think is banking on the fact that house prices tend to go up on the planet, and with rising populations and 350,000 people
entering Canada, every single year.
And so they're hoping that the prices will stay at least stable. But that's how shared equity works. So people have to understand that when they get in, they're getting into a bit of a partnership with their federal government.
Right. So would you say, is it better to pay it off quickly or just wait? I guess you never know, right? It just depends on what the market's going to do. And
well, yeah. It's an interest-free, payment-free loan, so it's kind of, people keep calling it free money, which it's.
You got to pay it off.
You have to pay it off. And, nothing's free. So, over time, you're having these savings. but if you want to be, if you feel like your property is going to rise a lot in value,
you want to pay it off.
Probably the best idea would be to pay off, and then otherwise, if your property, which, I mean, you're gambling, I guess, at the best of times with property prices. But if your property's not going to really appreciate very much, it might be better to hold on to that money.
So Michael, tell us about the percentages that are available for this incentive.
Okay, so the federal government, once you come up with your 5% down payment from traditional sources, the government on a resale property will provide you with 5% to add to your 5, so you've got a total of 10% down. On a new build, they'll do either 5% or 10%, so there's a little bit of an additional amount of money. And they're focusing on that market because there's about 680,000 new homes being built and people moving in. So that's a market that they're trying to also help out. This loan it has to be insured with CMHC, Genworth, or Canada Guarantee, but it has no monthly payment. And
so that's incorporated into your mortgage, right?
Right. And so with the no monthly payment, your repayments, like we mentioned, it's not free money, but your repayments based on fair market value should you sell the property at some point, or at the end of 25 years. Now, different than banks, if you decided you wanted to pay back the whole amount that was lent to you by the government, you can do that at any time.
Right.
You get an appraisal, you'd find out how much the property is, and then they would take their 5%.
Right. And Michael, now we were talking about, is this something that the buyers should be taking advantage of? What does it look like in terms of the savings, and do you have the numbers, or could you give us more like?
We could probably, CMHC has a hypothetical example out, and they talk about kind of a 400,000-ish house. So you're looking at your $20,000 5% down payment. Government augments with another $25,000 to take it to 10%. That also decreases your insurance premium. So that's kind of a nice thing that happens when you add another 5 in. So you save some money on that other side. But when the payment price comes down, and in this case it was about $123 a month. So if they're going to give you $20,000, what you should do with the savings, I guess, is you should put it in a bank account and start, putting it away to pay them back eventually. Right? So if you took $123 and forget about interest, but if you just took the $123 and put it in a savings account every month over 25 years, you'd have about $36,000.
Nice.
So when you're running those sorts of numbers, you've always got to think about that appreciation amount and how it's going to change. But in that scenario, if your house price stayed about the same, you'd be ahead about $16,000 at the end of the day.
As long as you would be consistent with, putting that $123 on the side, right? You don't want to spend that.
Trick.
Okay,
yeah.
So essentially what could happen is that you can, in the savings, you can in those 25 years pay for the initial loan, depending where it's going to be after that 25 years with the home equity or the value that you would have.
Yeah. Now, in that case, if you were to have $30,000 or $36,000 in the bank, I mean, that's your house price would have to swing a long ways to sort of eat up that $16,000, I guess. You're up over $600,000 at that point.
Right. Okay, so I hope that was helpful for you guys. And again, if you have any questions, Michael, where they can find you?
Well, you can get me at hubermortgage.com, and we've also got, I just wanted to mention before we cut off, Trudeau announced this change to the home buyers program today. So they're talking about changing this sort of maximum household income in Vancouver, Victoria, and Toronto. So, if you've got questions about that, that's going to be kind of rolling out over the next little while, and quite a bit of change. So he's talking about taking the maximum household income from 120 in those areas up to 150. And that would allow the maximum purchase price of the home to, in our current scenario, it's about $505,000. In that scenario, you're looking more like $786,000. So it makes a big difference in those hotter markets.
Right, because you can't probably buy much for $500,000 in Vancouver, Toronto, right? So obviously, it's going to be probably better, obviously, for people that are living in Kelowna. But yeah, Vancouver and Toronto, it probably wasn't enough for them too. I don't think you can even buy a 1-bedroom condo in Vancouver for that amount of money. So, okay, so that is great. So again, Michael, can you give us your contact information?
Yeah, thanks. I'm at hubermortgage.com, 250-212-7954. I'd like to thank Michael again for taking time here.
No, thank you, Michael, for being part of this, and I hope we're going to get another update about those changes that might take place over the next few weeks, and we'll keep you informed.
All right.
Thank you so much.